Hello, and welcome to our Inside Insurance M&A Due Diligence and Contracts webinar. This is our final webinar in our three-part series about insurance M&A that's been released throughout this year. I'm your host, Matt Staninger, Market Research Analyst here at Oak Street Funding, and joining me today is Chris Hughes, Managing Director of Insurance Distribution at M&A Services. In this segment, we'll be discussing the crucial steps and common pitfalls in due diligence and contracts. We'll also explore the M&A process, the role of letters of intent, key contract types, and more. Chris, thank you for being here today.
Matt, thank you for having me. I've really enjoyed doing these webinars, and I'm looking forward to this third and final part of the series here.
We've enjoyed having you. So starting off in this segment, let's talk about a brief overview of the insurance agency M&A process and talk about the key steps that lead to due diligence and contracting.
Yeah, sure. So in February, we did a webinar on the M&A process overall, and there's three and in July, we did the second part of it, agency valuation and deal structuring, and now we're going to do the third part, which is diligence and contracting. So the whole M&A sell-side process is really divided into stages. There's this preparation stage that takes 30 to 45 days. And in that stage, that's where we're gathering information from a seller that someone's looking to sell their agency. We gather their financials, we gather the historical income statements, their balance sheets, book of business reports, things like that. And we create a pro forma income statement to come up with what pro forma EBITDA is. We have some projections on there. We work with our sell-side clients to develop, what pro forma EBITDA is, what we think common deal structures are going to look like, and if they want to move forward. And if they're like, yes, we do, then we help develop a confidential information memorandum or a SIM, an anonymous fact sheet, a draft NDA that we would use with buyers. So all of these marketing materials and gathering information from the seller and working with the seller, that takes about 30 to 45 days before you even start the marketing process. And that's stage one. So we talked a little bit about that in February. In the marketing process, that's when we go out to our initial buyers. So we'll come up with a list in conjunction with the seller, and we go out to the buyers and have them execute mutual non-disclosure agreements with the seller. Once those NDAs are in place, then we distribute the SIMs to each individual investor or buyer into it, and they'll have a chance to review the information memorandum, which covers like all aspects of the business, all financials, all adjustments to any of the financials. I mean, it really gives a great in-depth view of the business and about, say 15 to 30 pages, plus maybe exhibits with financials onto that. Once we've delivered the SIMs to the buyers, you give them a week to 2 weeks to digest that. We'll start setting up buyers meetings with the seller. Since COVID, a lot of those meetings have gone to Zoom or Teams meetings, but still there's a fair number of them that can happen in person. So we schedule those meetings over maybe a, 2-week period, sometimes 3 weeks, just depends on, buyer and seller's availability. And if you're working around holidays or things like that, you have those meetings. That's where the seller gets to interview the buyers. That's where the buyer gets to interview the sellers and follow up on any questions that they'll have on the SIM or the financials or anything. And then from there, we solicit letters of intent after all of those meetings have occurred. Those are all the steps that bring us to soliciting letters of intent. And a letter of intent is just a non-binding, written, signed offer by the buyer and then negotiated and then signed by the seller. So those are the stages that takes us all the way to what we're going to talk about today, which is due diligence and the contracting phase.
That's a really great recap of the deal structure that we had reviewed earlier in the year and getting into our main focus today. So appreciate that, Chris. And that area that you just had mentioned was that LOI, that letter of intent. Let's get a little deeper into that with its essential components and why does the LOI play such a pivotal role in acquisition?
Sure. So the letter of intent or LOI is non-binding in nature, and depending on who the buyer is and what terms they put into the LOI, that can be a 3-page document or as long as an 8 or a 9-page document. Just as an example, AJ Gallagher is a frequent buyer out there, as most people know, and AJ Gallagher's letter of intent runs about 8 or 9 pages. It's very detailed. it tries to cover a lot of the terms that are negotiated a lot of times in the purchase agreement, but they just want all of that done up front. So there's a very, very clear pathway and very detailed pathway from signing an LOI to closing. And then you'll have other LOIs that are just 2 or 3 pages long. But the key terms that go into every LOI, no matter who it is, you have the purchase price, you have the closing consideration, whether that's cash, stock from the buyer, seller equity, whatever the terms of that cash and closing consideration are, you have that in the letter of intent. You have the earnout terms and conditions and amount. So almost every offer that we see for an insurance distribution firm has some type of earnout, whether that's based on revenue or EBITDA, whether that's over a 1-year, 2-year, 3-year period, whether there's growth hurdle rates or whatever. All of those terms are spelled out in the LOI. If there's any conditions of sale, so oftentimes if you're an MGA, a managing general agency, you have one carrier, and a common condition of sale is for that carrier to consent to a new buyer, new ownership. Another key term is whether it's going to be an asset sale or a stock sale or some other type of transaction type, and any liabilities that are going to be assumed, the most common one being a lease assumption. So those are key terms included in every LOI. A few others that I just want to touch on are there's an exclusivity or no shop provision in an LOI. So most buyers, almost all buyers, expect that when you sign a letter of intent with them, that you're going to stop marketing your company and you're only going to negotiate with them. You've reached a deal conceptually, and you're going to march through the diligence and contracting phase and get to the end of a deal with them and not shop yourself anymore. So that's a common term, and that's one of the very, very few provisions in a letter of intent that is binding, and it says that.
Great detail there. It's going to lay out your structure, essentially your term sheet of what you're expecting to close with, and finalize what those ideas are, and continue the discussions there. During those LOI negotiations, what specific terms or issues in there would you say buyers and sellers should prioritize to set the stage for the most possible successful deal?
Sure. So buyers and sellers, the very, very most important items to negotiate at this stage, especially for a seller, well, I guess for both, but especially for a seller, are the purchase price, the closing consideration, the terms of an earnout, the terms and the amount of the earnout. Those are the 3 biggest things that, make up, sellers are looking to maximize the valuation of their business, right? And you can do that right now at this stage. It's much tougher to do after you have a signed LOI. It's much tougher to do when you're only negotiating with one party and you're not in a process and you have multiple bidders, right? So purchase price, closing consideration, and the terms of an earnout are the 3 things that I think you should really, really focus on in making sure that you get right and fully negotiate as much as you can prior to signing an LOI. There's a few other provisions that could be important that you want to make sure right now is the time to do that. Those could be the terms of a non-compete for the seller. It could be the consideration and employment agreement or consulting agreement terms or producer agreement for either the owner or key producers. And whether that's like, I don't know, you're moving from a 50-50 commission structure to a 40-30 commission structure, now's the time to make those adjustments. Defining EBITDA or net revenue, whatever your earnout's based on, making sure that there's a clear understanding, for both parties, understanding how EBITDA and net revenue is going to be measured for the purposes of the earnout. So those financial pieces, a little bit of the non-compete, a little bit of the consulting, terms, and, definitional EBITDA or net revenue, whatever the earnout's going to be based on. Those are the key points that I think are the most impactful when you're negotiating to sign an LOI.
I think you make a really great point there, talking about making sure that you're measuring EBITDA, making sure you're measuring revenue, similarly or identically to come to that agreement and understand really what's behind that multiple, what's behind that final purchase price. Let's continue on this roadmap that we're going through. Now the LOI is signed, we go into the due diligence phase. What does that due diligence phase look like, and what are the primary goals for the buyers and for the sellers?
Sure. So let's just talk about the whole purpose of due diligence, right? We've delivered to a buyer a confidential information memorandum with all the financials, with all the adjustments, right? We told them that for the last 3 years, revenue was 10 million in revenue, 11 million in revenue, 12 million in revenue, and we have a 40% EBITDA margin going through those years. This is what our salary roster looks like. We sell property and casualty insurance and employee benefits insurance with a little bit of wealth management, right? We've told them all of this information in the SIM. They've sat down with us in person. They've had a 3-hour meeting. They've asked follow-up questions. They put together their letter of intent. We've negotiated to a signed document. The entire purpose of due diligence is to confirm all material aspects of the business and everything that we've told them. So if we said that we had $12 million in revenue last year, they're going to want to see bank statements, carrier statements. They're going to want to independently prove and verify that the information that we've provided so far and told them and that they based their offer on is true and accurate. That's the primary purpose of diligence, and it focuses a whole lot on the financial aspect of the business. In addition, you have, in addition to financial diligence, you have operational diligence and you have legal or corporate diligence. Operational diligence would focus on HR is a big area, IT is a big area, leases and where you operate your business is a big area. And then on the corporate legal side, they'll want to see the leases. They want to see the contracts, right? All of those things. But the whole purpose is to make sure that everything that we've told you is true and accurate. We're not in any trouble with any kind of regulatory entities or anything like that.
Great. And you got into some of those key aspects for each area of due diligence with financial, operational, and legal due diligence. What are some of those typical pitfalls or some of those obstacles during due diligence that tend to come up more often that may either make a deal take a little bit longer or make those initial terms have to change going into a final signing from the letter of intent?
Sure. So let's just take each one. So financial diligence, right? In general, for larger deals, say over $10 million in transaction value, 10 to say $150 million in transaction value, buyers will most likely hire a third-party financial diligence firm. That can be a Big Four accounting firm. That can be, M&A Advisors or one of our competitors, right? But they're going to come in and hire a third party to do what's called a quality of earnings. And that firm is going to request all of this financial information that I mentioned before. Tax returns, 2 or 3 years of monthly bank statements, carrier statements. They're going to request all of this financial information. They're going to pull that out and they're going to create their own pro forma. They're going to ask for all of the information that we use to make any adjustments to that. They're going to ask for salary rosters. They're going to prove that with W-2 statements. I mean, it's really an in-depth financial process. And when they're doing that, maybe there's things in there that aren't accurate. Maybe there's things in there that are like, we hear you that, you only have 40 employees and you don't pay health insurance, but we're a big firm. And once you join our big firm, you're going to have to go on our health plan, and that health plan from the employers, that cost 10% of your revenue, right? So they might make an adjustment like that. Hopefully we've caught that and we put that in the SIM in the first place, but sometimes I've seen that happen, right? So you have repricing on maybe the pro forma adjustments don't hold up, right? Maybe you lose a large client, right? That's 15% of your revenue. And you said you had 12 million in revenue, but during the diligence process, during the 60 days, we just lost a client that made up 15% of our revenue. So rather than $12 million, the business is really $10.5 million in revenue, right? So that can cause a repricing. Generally, if it's 2 or 3%, if the revenue and the EBITDA is within 3, 3-ish%, it doesn't really trigger a repricing. It's really when it's over 5 to 15% of either a revenue increase or decrease or an EBITDA increase or decrease that you'll see a buyer come back to you. And really, we have to go back to the buyer if we've gained a client that's like, hey, we just landed a client that's going to increase our revenue by 15%, right? It's less often than a repricing on the downside. You can also have third-party assignments. That's a common pitfall, right? If you don't get in front of those 30, 45 days in advance of a closing and you need a landlord's consent, you want to make sure that you're not waiting to 3 days before closing to get that consent because it's outside of our hands and that guy might be on vacation. You just don't know. So you want to be in front of all your third-party consents. Carrier consents are a big one, especially if you're a local or a regional agency and you have local and regional carrier contracts. Some of those local carriers aren't interested in assigning their contracts to larger aggregators at this time. So matching up those carrier contracts with the buyer and understanding which ones may or may not want to assign their contracts to the buyer. You want to get in front of that issue and know that issue and have a solution for it. And if you know that a carrier is not going to come over, the buyer's got to know that. You've disclosed it already in the SIM, who your largest carriers are, so it's a little bit of the buyer's problem, but really in diligence, everyone's rowing in the same boat to get to the finish line, and you're trying to solve that carrier consent problem. In every deal, almost every deal, there's some kind of either customer or client concentration or a producer concentration. Maybe you have a producer makes up 30% of your business. You need to make sure that that producer is going to be on board and happy with the transaction, right? So there's a producer concentration risk. You have, if you're an MGA, you have underwriting risk. So is the carrier going to give consent? If not, do you have all the financials and the underwriting data to show that this program's a profitable program that we could move and ship to another carrier if needed? I mean, you have these kinds of risks that are all coming out and being discussed in diligence because the buyers are like, hey, we need to talk about this. We need to talk about this, right? Because I'm shelling out all my money. All the risk shifts from the buyer to the seller from the seller to the buyer the day after closing. So you can expect all of these issues to be discussed and talked through. And then finally, not really a pitfall, but it's always on people's radar, are any kind of legal issues that you just need to make sure are wrapped up. Are all your corporate books in order? So your attorney will help you work through that. Do you have any pending or past E&O claims or lawsuits in the past 5 years? Let's make sure that we have all the documentation to prove that those have been resolved or we know exactly where they're at. Anything like that. Do we have all the licenses up to date for the business, for the owner, for all of the producers? Things like that. But all those legal issues get updated and, good to go prior to closing.
Great description there. And really that really shows the importance of making sure that you're doing that prior to due diligence and having accurate disclosures within the SIM.
That's right.
Now we're moving into the contracting phase. What are the primary types of contracts involved in agency M&A, and what roles do they serve while closing the transaction?
Sure. So once we have a signed letter of intent and we start the diligence process, and we have the finance team working, we have the HR and operational team working, the lawyers start to work, and they start working on their legal diligence as well, legal and corporate diligence. They've requested, all the corporate minutes. They've requested all the licenses. They've requested all the formation documents. We've uploaded those. They'll start preparing, the buyer's attorney will start preparing a purchase agreement. And depending on the type of deal it is, it can be an asset purchase agreement. It can be a stock purchase agreement. It can be a membership interest purchase agreement. It depends on the deal. That is the primary document that is used, that goes from LOI. This is the documents that are going to be signed. This is the one that's going to sell your business. As part of that purchase agreement, there's schedules, and the schedules are part of it, but really it's almost a separate undertaking to put together the schedules. So, for example, there's a portion of the purchase agreements that talk about reps and warranties. And maybe section 4.2 says we represent and warranty that we have no 1099 contractors, comma, except those listed in schedule 4.2. So then you have to schedule out 4.2 and list all of your 1099 contractors. There's a schedule almost for every paragraph of the reps and warranty section. So that can be a fairly large undertaking. And even though it's not a standalone document, you have a purchase agreement, you have the schedules and exhibits to the purchase agreement, you have an executive employment contract or a consulting contract almost in every deal. It's rare that the owner or seller walks away the day after closing. So there's always some kind of consulting or employment agreement for some period of time for the seller. There's key employment agreements or producer agreements for the key employees, just depending on how large or complex it is. Sometimes you have separate non-compete agreements. There'll be a non-compete provision in the purchase agreement, but there's sometimes separate non-compete agreements that just stand alone. On smaller deals, maybe sub $5 million transactions, oftentimes there's a seller's note or a promissory note to it. And then in many transactions with a lot of the more prevalent buyers out there, World Insurance, Alkeem, King Insurance, the Hill Group, you have buyer equity documents because they'll offer 80% cash at closing and 20% buyer's equity. So that buyer's equity come with their own documents. They're really non-negotiable documents. They just are what they are. But those are key contracts in every deal that have to be signed.
So we'd already went through this with the letters of intent for areas to look for. That, of course, being kind of a shorter document, 3 to 8 pages typically. This, of course, has a lot more detail into it with so many different items that can be on schedules. So when a seller or a buyer's party is looking at the purchase agreement, which sections should they typically pay the closest attention to?
Well, again, it almost mirrors what I said about the letter of intent. So from a seller's perspective, right, they retained an outside attorney. And I think it's important to emphasize that sellers should hire an attorney that does insurance agency transactions, right? Hopefully they've hired an M&A advisor, and we have a number of attorneys that we've worked with. This is all the attorneys do day in and day out. So you're not paying for a learning curve, and you're mitigating risk with an inexperienced attorney within the insurance agency space, right? So these attorneys know how the businesses work. They've often worked on the other side of the other side's attorneys. So there's some kind of relationship there. They know what market is, and they can get you to the finish line. So it's really a risk mitigation factor more than it is anything else. And while, M&A attorneys in general, but M&A attorney insurance ones specifically can charge a little bit more per hour, they are very cost effective overall just because of the knowledge that they bring to the table. But the key terms that you would look for from a seller's perspective are the purchase price and terms of that. Again, that's cash and other consideration, right? Is it 8 million cash and 2 million stock, buyer's equity? Is it 6 million in cash and I've got 20% that I'm going to retain in my own equity and 20% in buyer's equity? So those terms are important. The terms of the earnout are important and how it's measured. And then from the earnout terms, the next section you would jump to are the definitions, which are spelled out in detail. So an LOI might spell it out in one sentence. These purchase agreements run 50, 60 pages long. There could be a page on the definition of EBITDA, right? So those are super important. Then with your attorney working with you, you'll look at the reps and warranties of a seller and the indemnification section of the purchase agreement. So you have purchase price and terms consideration, you have earnout terms, and then you have a big section of the purchase agreement is reps and warranties of the seller. I represent that I own this company. I represent and warrant that there's no tax liabilities against me. I rep and warranty that I know no customer that's going to leave, right? All of these representations. And then behind that, there's an indemnity section, and the indemnity says, if I breached one of these reps and warranties and that caused you harm, I will indemnify you for it, right? So that's generally what it says, but there's also, hey, I just sold my company to you for $10 million. I'm not going to indemnify you for the whole $10 million. So there's a cap. Generally, that's a percentage of the purchase price, anywhere from, say, I don't know, 10 or 20% on the low side to 40 or 50% on the high side of the purchase price as an indemnity cap. Oftentimes there's a deductible, meaning the buyer's not going to come after me even if I breached a rep unless it reaches some level of materiality. So there can either be a basket or a deductible of some relevant amount before I would even indemnify a buyer at all. So that's important. And then I had mentioned those schedules being a separate document, but getting those schedules in order and having those sent over in draft form to the buyer at least 3 weeks prior to closing is important, because the buyer may have some comments and say, hey, I thought we talked about this, and did we miss this? We want to make sure that those schedules are all in order. So those are the key sections that I think is super important to make sure that the seller is focused on.
Great, which really works hand in hand, as you had mentioned, in having a legal team that has industry expertise and specifies with insurance.
Yeah, and I'd be remiss if I didn't say, when a bank's involved, that's just another level of diligence and good set of eyes that generally are rowing in the same boat as everybody else to get to the finish line. So having a bank involved just adds to the credibility of all aspects of diligence in the contracting phase going forward.
You mentioned there needing to be a significant amount of time for the buyer, again, to be able to review this final purchase agreement, as there may be some things that end up coming up, maybe hadn't been discussed, or they weren't quite on the same page of communication as to what the purchase agreement states. What are those common areas where there may be either a mistake or a miscommunication or some kind of challenge encountered when negotiating and finalizing that purchase agreement and the related contracts with it?
Yeah, so some of the things that I've seen become super acrimonious would be the definition of EBITDA, or net revenue, and how that's calculated, and how your accounts receivable or accounts payable work, right? So oftentimes, and I would say it's in the majority of cases, the day after closing, if the revenue comes in, it's for the benefit of the buyer, right? But oftentimes the seller's written all of these accounts for the last 30 days, and then going forward, they're like, hey, we wrote this account in May. We should get the revenue for that comes in June. We wrote it. We sent an invoice, but we didn't get the check until 2 days after closing. So making sure that you have a clear understanding of how the cash works, right at closing and going forward. That's point one that I see come up. Point two is working capital, and that works right into this. So how you keep track of and who gets the benefit of the accounts receivable. So oftentimes a seller has to leave in 30 to 60 days of working capital, and that's 30 days of whatever the operational expenses of the business are. So if it's running, say, $1.2 million in annual expenses between payroll and rent and commissions and all of that, that's $100,000 a month. So if you have a 30-day working requirement, it's leaving $100,000 in there. If that's not been negotiated at the LOI phase, sometimes you see that become a sticking point. So hopefully you've got a good advisor that said, hey, we need to make sure that we've worked this out at the LOI stage so it doesn't become a sticking point in diligence. If you have, I've seen carriers that are running hot with MGA transactions. Hey, are we going to keep this carrier, right? So we need to make sure that we're going to get the consent of a carrier and working through that through the purchase agreement. The timeline and the amounts of those indemnifications, it's generally more the attorneys that get hot on them, but on some of the calls between the attorneys and the sellers, right? Whether you have a 50% cap of purchase price on the indemnity or a 20% cap, that can become a point of contention, and whether that indemnification lasts for 18 months or whether it lasts for 5 years, that can be a point of contention. Not that they're not always worked through. But in general, if the business is going well, if it's growing, if it's doing what was presented in the SIM, almost all of these issues are lesser issues than buying a good business.
Right. Again, goes to that key of preparation there.
Yeah.
So we have a lot of details that go into this process. How long, and this of course is going to vary by deal size, by complexity, by structure, probably by acquirer, whether it's a newer acquirer or a serial acquirer, but how long should we expect that diligence period and the contracting phases to typically take? And what's involved at closing and the level of effort that buyers and sellers should expect throughout that process?
Sure. So the timeline for closing, from the time you sign a letter of intent to the closing date, that can vary anywhere from about 45 days on the very shortest end to about 90 days at the longest. If something's dragging out past 90 days, there's probably something that's going wrong and your deal's at risk. 45 days is about as fast as you can get different parties to move, especially if you have a third-party financing firm, you have a third-party attorney, maybe there's a bank involved, maybe the buyer is owned by private equity. It's a deal that's the size that they want to be involved. So you have all of these moving parties, as well as the seller's CPA, the seller's attorney, right? And you're trying, so getting everyone focused on a closing date to do something in less than 45 days is tough. Getting through all of the diligence in 45 days and contracting and going back and forth with the purchase agreement can be tough. So generally, I would say 45 to 90 days. The second part of your question, what's the level of involvement? So this phase of the M&A process is by far the most stressful for a seller and the most time intensive for a seller. Putting together all of those schedules, looking up all of those corporate things, getting all of those licenses together, right? Getting all the W-2s together, answering all the questions from the third-party financial team, answering questions from HR, matching up your benefits plan to the buyer's benefit plan, right? It's very time-consuming. You're having to dig up a lot of stuff that you might not have looked at for the last 20 years. You have all kinds of different parties asking you very direct questions about you and your business and your finances. So it's a very stressful process. And then at the end of it, we're just answering questions, and you have it going into the third-party financials team kind of black box. Are they going to see net revenue and EBITDA the same way that we did? Right? And in general, when you're working with a professional M&A firm, the SIM and the pro forma stands up pretty well. So generally, you should reach you sign an LOI for $12 million, you should reach the finish line at least at that. But it's a very, very time intensive and stressful time. Phase one, you're gathering information. You're like, oh, my M&A advisor is telling me my business is worth $12 million. That's great. That's more than I thought. And then you go through the marketing process. Oh, wow, I got 5 offers for $12 million and 1 offer for $13 million. That's great, right? And then you sign an LOI and they're like, there's nothing great about this. All I'm doing is like digging up all these documents, putting them in a data room, answering questions, setting in meetings. I mean, it's a stressful and intense, 45 to 90 day process to get to the finish line.
Absolutely. Chris, I want to thank you for taking the time, not just today, but for the other 2 parts of the segment as well, and sharing your insights with our audience. We appreciate everyone who tuned in today and submitted questions. Thank you all for your continued viewership. Stay tuned for more from us here at Oak Street Funding with new content and new guests. Thanks again.
Yep. Thanks for having me, Matt. I appreciate it.
Really appreciate it, Chris.